When we think about what causes major wars, we usually hear about things like ideology, border disputes, or ethnic hatred. And those things definitely matter. But what if I told you that some of the biggest conflicts in history were also fueled by something much less dramatic, something that looks a lot like your credit card statement, just on a global scale? Many historians and economists point to a hidden driver of war: money, or more specifically, massive unpayable debts between nations. This isn't just some abstract theory. It's a pattern that has repeated itself throughout history, and some analysts are seeing worrying echoes of it today. It's a cycle that often unfolds in 3 stages, a recurring pattern when powerful countries get tangled up in each other's finances. Let's break it down. Stage 1 is what we can call financial interdependence. This is the honeymoon phase. A rising power might need money to build its industries, and an established power has cash to spare. So, they start lending and borrowing. The creditor nation buys the debtor nation's bonds, and the debtor nation uses that money to grow, often buying goods from the creditor. For a while, this looks like a win-win. Everyone is making money, and the conventional wisdom is that countries that trade together and owe each other money won't go to war because it would be bad for business. It creates a sense of stability. But then we drift into stage 2, debt stress and economic friction. The numbers get bigger. The debts become so large that paying them back starts to cause real pain back home. The debtor nation has to choose between paying its foreign creditors and funding its own schools, hospitals, or military. To cope, they might start using financial tricks. Maybe they print more money, which causes inflation and quietly reduces the value of what they owe. Or they might throw up trade barriers and tariffs to protect their own industries, trying to sell more and buy less. Suddenly, that friendly economic partnership starts to feel like a competition. The creditor nation gets angry because the value of their investment is shrinking, and the debtor nation feels squeezed and resentful. Mistrust grows. Economic cooperation turns into economic warfare. This leads us to stage 3, the risk of systemic breakdown. This is the danger zone. The economic friction becomes so intense that it spills over into geopolitics. The tools of finance and diplomacy stop working. The arguments are no longer just about interest rates or trade balances. They become about national pride, security, and survival. Historically, this is the point where the risk of conflict skyrockets. War becomes a way to hit the reset button on the entire financial system. A war can wipe out debts, change borders, topple governments, and create a new world order where the old obligations no longer matter. Now, this isn't just a theory. Let's look at the run-up to World War I. In the early 1900s, Europe was more financially connected than ever before. Great Britain was the world's banker, lending vast sums to other powers, including its future rival, Germany. They were all on the gold standard, a system that was supposed to keep things stable. But beneath the surface, tensions were building. Countries were locked in an expensive arms race, and trade imbalances were creating friction. The assassination of Archduke Franz Ferdinand was the spark, but the whole system was like a forest that was dangerously dry. The underlying financial and economic pressures had made Europe incredibly fragile, and it didn't take much to set the whole thing ablaze. Then came the aftermath. The Treaty of Versailles imposed crippling reparations on Germany, essentially a massive debt. At the same time, the Allies owed huge war debts to the United States. This created a fragile triangle of money flowing from American banks to Germany, from Germany to Britain and France in reparations, and then from Britain and France back to the US to pay off war loans. It was a house of cards. When the Great Depression hit in 1929, the American loans dried up and the whole system collapsed. In the chaos that followed, countries turned inward. They embraced economic nationalism, protectionism, and rearmament. The unresolved debts of the First War directly fueled the economic despair and political extremism that led to the Second. So, why does any of this matter today? Because if you look closely, you can see some of these same patterns emerging in the 21st century, particularly between the world's 2 largest economies, the United States and China. For decades, we've been in a state of deep financial interdependence. China has manufactured cheap goods that American consumers love, and in the process, has accumulated trillions of US dollars. What did they do with all that money? They lent a huge portion of it back to the US government by buying treasury bonds, which helped finance American deficits and keep interest rates low. For a long time, this arrangement was called Chimerica. It seemed like a perfect symbiosis, a modern version of that stable, interconnected system. But are we now entering stage 2? We see the signs of economic friction everywhere. There have been trade wars with massive tariffs on both sides. We see intense competition over technology, with the US placing restrictions on China's access to advanced semiconductors. There's a race to dominate the industries of the future, from artificial intelligence to green energy. Both countries are increasingly viewing their economic relationship not as a partnership, but as a zero-sum competition. The language has shifted from cooperation to rivalry. Think about the strategic importance of Taiwan. It's often framed as a political issue, a question of democracy versus authoritarianism. But it's also a critical economic choke point. Taiwan, through TSMC, produces the vast majority of the world's most advanced computer chips, which are the lifeblood of the modern global economy for both the US and China. Control over that resource is an enormous strategic prize. Now, I want to be very clear about something. None of this means that a war between the US and China is inevitable. History is a guide, not a crystal ball. It shows us patterns of risk, not a predetermined future. There are many ways this story could end. Nations can and do negotiate their way out of financial crises. They can reform international institutions. They can choose diplomacy and de-escalation over conflict. But what history does teach us is that periods of intense great power rivalry, combined with deep financial entanglements and stress, are uniquely dangerous. The economic tensions can easily bleed into military and political ones, making miscalculations more likely and crises harder to resolve. Understanding this debt and conflict cycle isn't about fear-mongering, it's about being realistic. It helps us see that the headlines about trade disputes or tech bans aren't just business news. They are part of a much larger and older geopolitical story. It shows us how the choices made by central bankers and finance ministers can have as much impact on peace and security as the decisions made by generals and diplomats. Recognizing these patterns gives us a chance to learn from the mistakes of the past. It reminds us that keeping the lines of communication open and managing economic tensions wisely is not a sign of weakness. It's the essential work of preventing a catastrophe. The outcome is not yet written. It will be shaped by the choices we make today. Thanks for watching. If you found this perspective interesting, please consider liking the video and subscribing to the channel for more deep dives into the forces that shape our world. See you next time.